Let's talk about incentives. Why would independent companies, which legally must compete, risk severe penalties by colluding? Let's start with margins. In many markets, especially where products are relatively similar cement, chemicals, trucks firms compete by cutting prices to win sales. This competitive pressure drives margins down. If firms can coordinate, even loosely, they can maintain higher prices and more predictable profits. Secondly, predictability. Competition creates uncertainty about rivals' next moves. Collusion, again, even tacit, can bring order, fewer price wars, more stable market shares, smoother planning for capacity and investment. Managers measure on quarterly results that stability is tempting. Third, repeated interaction. In many business to business markets, the same players meet again and again. Monthly tenders, annual contract renewals, regional procurement cycles. Repeated interaction can support understandings like we won't undercut in your region if you don't undercut in mine. Fourth, market structure. When there are only few major players, it's easier to find and maintain consensus. A handful manufacturers or big banks can align more readily than dozens and dozens of small companies. Case examples ground this. In the EU trucks cartel, large manufacturers coordinated list price increases and timing related to emission technologies over many years. In foreign exchange spot trading, traders at several banks exchanged sensitive information and aligned strategies in chat rooms. In air cargo case, airlines coordinated surcharges. These are extra payments for fuel, for example. Across these, the economic logic is similar. Higher, more predictable revenues by softening competition on key price elements. All that said, collusion is risky. Penalties in the EU can be up to 10% of global turnover per company, and there's a rising private litigation from harmed customers seeking damages. So, why do companies still attempt it? Because when successful, the extra profit can be very, very large, and individuals inside companies may believe the risk of detection is manageable, especially if coordination is disguised as industry discussion facilitated via third parties or achieved tacitly without explicit written agreements. One subtle point: not all coordination is about headline price. Firms can collude on surcharges, extra charges, discounts, timing of increases, technical standards that raise rivals' costs or limit rivalry. Sometimes the agreement is simply to slow the diffusion of new cost saving technology, keeping industry costs and prices higher for longer. The economic temptation is the same: preserve margin by avoiding competitive surprises. Finally, incentives can be personal. Traders on the desk, sales managers, or country heads may see short term bonuses tied to price realization or volume stability. If the culture isn't robustly pro compliance, the temptation to make a quiet phone call or join a closed chat can be strong. That's why modern enforcement look hard at communications and why internal compliance programs matter.